have been saying that financial modeling is a mathematical model, which means if you want to be good with financial model, then you have to be good with mathematics. Is that bringing you all the dreadful memories from school days? Well, don't worry, because most of the models that we build do not require much complicated mathematics beyond what you might have learned in your high school. Yes, there are some complex models that require some advanced mathematics, but what most of us in the industry build requires fairly simple mathematics. And that is what you would be learning in this and the next chapter. So let's start.
So in this lesson, you will be taught about the different types of variables we have and the kind of dependencies these variables have within themselves, and how do we model if the data is dependent on its own past or if the data depends on other data points. So these are all the things that we're going to learn today. First, let's start with the different types of variables. When you talk about types of variables, I would within that create two different categories. One is based on their nature and another one is based on their role. Based on nature, data can be either discrete or they can be continuous. What is a discrete data? Let us say there is an airlines and it has given a guidance that by next year they are likely to operate between 4 to 5 aircrafts. So the airline may have 4 aircrafts, or there is a possibility that they may have 5 aircrafts. Is it possible that they can have 4.5 aircrafts? No, right? That does not make any sense. Now this is an example of a discrete variable. So in case of a discrete variable, there are only finite possibilities within a given range, and the incremental values are significant. So when a value moves from 4 to 5, you notice that there is a 1 unit jump. Now let's talk about the continuous variable. Let us say the same airlines gives another guidance about the ticket price. Here they say that the ticket price can increase between 5 to 6%. Now what are the possible values that it could take between 5 to 6%? The ticket price can increase by 5%, it can increase by 5.5, or it can increase by 5.543%, and so on. You get the drift, right? So between this 5 to 6% range itself, there are infinite possibilities. Now this is a continuous variable. So when we talk about continuous variable, what we would say is that there are infinite possibilities within a given range and the incremental values are insignificant. Between 5% and 5.543, we notice that the difference is not very huge. Why did we spend our time knowing about discrete and continuous variables? Because later on, when we would talk about the form of equations, which form to use will depend on whether the data we are using is discrete or continuous. Now let's look at the other categorization, based on role. Based on role, the data can be categorized into independent data and dependent data. Now let's talk about independent data. If I asked you to think about a number between 0 to 10, you may choose any value that's between them. Now this is an example of an independent data. On the other hand, if I told you to tell me the difference between your age and the number you have thought, that's a dependent data, because this difference depends on your age and depends on the number you thought. Let's now talk about them in financial modeling. Where do we come across these terms? See, we know profit is equal to selling price minus purchase price. If I talk about calculating profit of a share, the selling price can be anything, because the market moves everywhere. The selling price can be anything, and that's an independent data, but your profit will depend on the selling price. So that's a dependent data. So talking in practice, the variables that we use as independent variables are those that either depend on qualitative factors or they depend on too many factors that it's very difficult to derive a proper quantitative relationships. So to give you an example, think of sales growth for next year. Now sales growth for next year depends on consumer sentiments and a lot of other factors, and therefore we typically use it as an independent variable in our financial models. Now let's talk about dependent variables. Now within dependent variable, there are 3 categories. One is serial dependency, or what I also call as time series dependencies. What are these time series dependencies? Think of your salary. So your salary next year would in a way depend on your salary this year. So that's an example of a time series dependency. Cross-section dependency is something that depends on another variable for the same period. So this is perhaps your disposable income. Your disposable income for this year depends on your total income and non-discretionary expenditures. What about panel dependencies? Panel dependencies are those data that depend on another data from the past periods. So an example I can think of is the amount of cash collected from customers. So the cash that you collect from a customer this month could be from sales that happened this month, part of it from sales that happened in the previous month, and so on. So talking from a financial model perspective, again, to give you examples of these three things. So let's look at the sales. If I see a trend in sales and it's increasing serially over month on month, then I know that this is a time series variable. On the other hand, the incentive I pay to my sales team, that depends on the sales I have done in that particular period. So this is an example of a cross-section dependency. Finally, when it comes to amount of cash we collect from customers, the cash that we collect from customers can be from sales of many periods in the past. This is an example of panel dependency. Now question is, how do I know whether a particular data is independent or if it's dependent? If it's dependent, then what sort of dependency? How do we figure these things out? So there are two possibilities for it. One, what we call as structural relations, that you already know how things work. So if it's incentive, I know the incentive is a cross-section dependent variable and it depends on sales because that's how the contract is. So either based on past knowledge, or maybe you have an economic theory that justifies the relationship. So when you try to arrive at a relationship based on these past knowledge or economic theories, we call it a structural relationship. But even when you come up with structural relationship, it is preferable that you verify the theory with actual past data. See whether things have actually worked as per the theory or as per the contract. The other approach is what we call a statistical relationship. So in a statistical relationship, you are going to derive the relationship by observing what happened in the past. You may not have a theory with you, but you're just going to see, okay, what happened in the past. Maybe if I have to look at amount of money you spend on gadgets versus your income, I might be able to come up with a trend. And that sort of a relationship is what we would call a statistical relationship. But when you're using statistical relationship, one thing you got to be careful is that this relationship should not be spurious. So for instance, if I were to compare the amount of push-ups that somebody does in a gym in a given day versus the number of cars that go by my road, maybe I may find a correlation. I may find a strong relation, but that's likely to be pure coincidence, right? So that's why even when you're using statistical relationships, some sort of common sense sanity check would be good to understand whether this relationship can indeed be true. But sometimes neither of these two give a very strong relationship. Sometimes the structural relationship says something else, statistical relationships contradicts it. In that case, what do we do? Most of the time, analysts use their judgment to choose between one of them. Now we've understood the basics of data. Having understood this, now let's get into modeling. By modeling here, I'm talking purely in terms of the mathematics side of it. We are still not talking about the spreadsheet. So when you're talking about a time series data, sometimes the data you look at do not exhibit any trend. You know, these data points are not independent. Their level has to be somewhere in line with past. But you notice that there is no trend as far as the past data is concerned. In that case, the base estimate would simply be the arithmetic mean. Almost all of us would be knowing what is arithmetic mean. It is simply sum of all observations divided by number of observations. But what about data that shows trend? When you have data that shows trend, there are two possible ways in which we can express the equations. So one form of equation is to use quantity change, where what we're going to do is we're going to say value at time t plus 1 is equal to value at time t plus d, where d stands for absolute increase in time t plus 1. So to give you an example, let us say last year we had 30 employees in the organization, and in the next year we plan to recruit 5 more. So question is, how many employees would we have at the end of next year? So value at the base time t is 30, and the d here that we are talking about, the change in the next year, is 5. So the value at the end of next year is simply going to be 30 plus 5, which is 35. The other way to express change is in the form of rate of change, where we are going to say value at time t plus 1 is equal to value at time t into 1 plus r, where r stands for the rate of change. A lot of us must be familiar with this, especially if you are working. This is probably how you are trying to work out your expected next year's salary. So to give you an example here, let's stick with the same salary example. So salary in 2019, let's say, is 40,000, but you expect a 5% increase next year. So the question is, what is the expected salary in 2020? So 40,000 is the value at time t and 5% is r. So the expected salary next year is going to be 40,000 into 1 plus 5 percentage, which is simply going to be equal to 42,000. And that's going to be our answer for this. Now in your school days, you might have looked at different equations where you might have learned it to be value at time t into 1 plus r into 100. Why aren't we using that 100 here? Because in practice, analysts typically enter these r either in percentage form or in decimals. So I may enter it as 5% in my system. If my programming language doesn't allow me to enter in percentage, I may type it as 0.05. So we talked about two forms, which is quantity change and another one is rate of change. Now, how do I choose between the two? How do I know whether to use quantity change or rate of change? That depends on the type of data you're dealing with. Now, I'm going to split our data into three categories. We already talked about discrete and non-discrete. And within discrete, I'm making two categorizations here. One is large discrete data and non-large discrete data. When you talk about non-large discrete data, you cannot use rate of change. And I'll talk about it shortly. So in case of non-large discrete data, we typically like to work with the quantity change form. On the other hand, if your data is continuous data, then we like to work with the rate of change. If you have a discrete data and the discrete data is very large, and by large here, we are giving it a contextual meaning. The large here is in relation to the minimum size of increments. If it's large compared to the size of increments, then we like to use the rate of change for that as well. So let's understand these things with a little bit of examples. So let's work out our first problem. Here we are trying to use rate of change for small discrete data. Let's say an airline has 5 aircrafts in its fleet and the fleet size is expected to increase by 15% next year. Can you calculate how many aircrafts they'll have next year? So 5 is what they have at time t, so that's value at time t, and r is 15%, so 5 multiplied by 1 plus 15% gives me answer as 5.75. Now is that even possible? And that's why we don't want to use this. But if I have small discrete data and if I use quantity change, then let's see what happens. So you have 5 airlines last year and you expect to increase the aircraft by 1 unit this year. So how many aircrafts will we have at the end of this year? It is simply going to be 5 plus 1 equals 6, right? Pretty straightforward math. Now this makes sense for us because we are expressing the change in quantity for small data, and that makes absolute sense. Now let's look at continuous data points where we work with rate of change. So they have an average ticket price of 1080 and the company expects to increase it by 12%. Now what is the expected ticket price next year? So going with our formula was value at time t plus 1 equals value at time t into 1 plus r. So if I stick to that one, I'm going to say it's going to be equal to 1080 multiplied by 1 plus 12%. And this number comes to 1209.60. It's in decimals. But it's a ticket price, correct? Ticket price can be in decimals. There is nothing wrong in it. So that way, this one also works. In the last example, we'll talk about using rate of change for a large discrete data. Let us say the company is selling 80,000 tickets. Keep in mind, tickets are discrete data. You cannot sell 80,000.5 tickets. The increment has to be in unit of 1. So you can sell 80,001, but it can't be 80,000.5. Therefore, it's actually a discrete data, but it seems pretty large. And I'll also tell you why it's large. So the company is selling 80,000 tickets and they expect the volume to increase by 5% next year. So what would be the sale volume next year? Sale in terms of tickets. It's going to be 80,000 multiplied by 1 plus 5%, which works out to 84,000. We are using rate of change, but we are still getting a whole number. This sounds absolutely fine. So how does it work here? And why do we think 80,000 is large? And where do we draw the boundary between large and small? As I told you, the term large here is relative to the size of change. Even if I were to take a small increment of 0.01%, that multiplied by 80,000 is going to give me a whole number of 8. And typically in corporate budgeting and forecasting, you don't take a rate of change in absolute terms that's less than 0.01. You may take 0.01 or minus 0.01. So that being the case, even if I take a 0.01% growth, I am going to arrive at a whole number, and that way this max works absolutely fine in my model. So that's why if your data is large and discrete, you can use rate of change. If your data is continuous, work with rate of change. If your data is small and discrete, we are going to work with quantity change. But there is one exception to the rule though, and that is when your time series variable is expressed in percentage. Let's say last year you got 20% of your salary as bonus. And this year in your corporate town hall, your CEO tells you that the rate of bonus will be 5% more than last year. So question is, what is your rate of bonus this year? Is it going to be 20% plus 5%, which is 25%? Or is it going to be 20% into 1 plus 5%, which is 5% of 20%, which is equals 21%? Now that's pretty confusing, right? Now if I were in your place, I would definitely be raising my hands and asking the CEO what he meant. Because this language is super ambiguous. And the reason it's ambiguous is because the bonus is also percentage and the delta is also expressed in percentage, and we don't know what they meant. So how do we handle this? And that's where I'm going to introduce you to the term called basis points, or what we in short write as BPS. Some of us even pronounce it as BIPS. If your time series variables is expressed in percentage, then the quantity change is typically expressed in basis points. 1 basis points equals 1 by 10,000 or 0.01%. Simply 1 basis point is 1 by 100th of a percentage. And what that means is 100 basis points makes 1%. And the general form we use is rate at time t plus 1 will be equal to rate at time t plus basis points by 10,000. Why are we dividing it by 10,000? Because 1 basis point is 1 by 10,000. So if you expect the basis points to increase by 50, then the net result will be 50 by 10,000. That's 0.5%. Now 10,000, I would like to write it as 10 to the power 4 so that I don't make mistakes with the zeros. So let's look at an example here. So let's say your rate of bonus last year was 20%. So this is the rate last year. So that's rate at time t. And the expected increase in rate is 50 basis points. So this is the change in basis points. So what is going to be the rate of bonus this year? So that's going to be 20%. And we know 20% is 0.2 plus 50 divided by 10,000. And as I said, I like to write it as 10 to the power 4. And 50 by 10,000 is 0.005, and that therefore I get equals 20.5%. The last part of time series growth that we're going to understand here is sequential growth and year-over-year growth. Now what is sequential growth? Sequential growth is the rate of change or growth rate between two successive periods of similar length. Year-over-year growth is the rate of change between a period and same period in the previous year. I'll give an example to explain this. So what we have in the screen here is the revenue data across 3 semi-annual periods. First half 2018, second half 2018 and first half 2019. Now if I were to look at the growth rate for first half 2019, One thing I can do is compare the 2019 first half sales with 2018 second half sales. And when I compare the two, what I notice is that there is a 25 decline. In other words, there's a 25 by 100, 25 percentage decline in sales. This can lead us to conclude that the business is on the decline. But there are two problems when you use sequential growth. The first problem is that the 2 half years do not have exactly same time. So if it's a simple calendar year we are talking about, then the first half of a calendar year would typically have 181 days, unless it's a leap year, and second half is going to have 184 days. And one more problem we have is that across the world, typically it is the second half when you have a lot of festival holidays. And that means if you're in a retail business or other business that depends on festival, you're going to witness much higher sales in second half than first half. So the number here that we see can as well be misleading. So what is the thing that we can do? So typically in financial models, what we do is we use what is called as a year-over-year growth rate. In year-over-year growth rate, we're going to compare first half 2019 number not with second half 18, but with first half 18. Same period previous year. First half versus first half, just the year is different. When you do that, what we notice is the 50 has grown to 75. That's a 25 jump on a base of 50, which is a 50% growth. Which growth rate should you use in your model? It also depends on the underlying circumstance, but unless you have a reason to believe that sequential growth is the best growth to use in your model, I would always recommend to work with year-over-year growth. Almost every business everywhere depends on seasonal factors, and definitely the difference in the number of days is an issue as well. Are these the only thing that we need to know about time series relationships? Not really. Some serial relationships can be pretty complicated. They may not just depend on one past period. They may depend on several periods in the past as well. Exponential weighted moving average models, or what we call as EWMA models, are some examples of such complicated models, but that is something slightly more advanced, so we are keeping it outside the foundation level. So we went through time series relationships. Now let's try and understand about cross-section relationships. When we talk about cross-section relationships, again there are two forms in which you can use your equations. One is additive relationship, where you may say a dependent variable depends on additive relationship between two variables. So yt is going to be equal to value of a at time t plus value of b at time t. Now a and b can be positive or negative. So if b is negative number, then this becomes a at time t minus b at time t, right? So let's look at a simple example. So your income for the month is 30,000 and your expense for the month is 18,000. And what is your operating profit? So income for the month, I'm going to note it as AT, and expense for the month is BT. Now expense is a negative number, so I'm putting it brackets. Typically in finance, anything within bracket indicates it's negative. So my profit, which is YT, is going to be equal to 30,000 minus 18,000, or otherwise I should write as plus of minus 18,000, which is going to be equal to 12,000. And that's what we say here as operating profit. The other form of cross-section dependency is a multiplicative relationship, where a value y at time t depends on value a at time t and value b at time t. Again, a and b can be positive or negative. Let's say my revenue for the year is 30,000 and we expect an operating margin of 40%. For those of you who don't know, operating margin is essentially operating profit upon sales. That is what we call as operating margin, and that is going to be 40%. So what should be my operating profit? So we know that operating profit upon sales is equal to 40%. That means we know operating profit should be equal to sales multiplied by 40%. In our case, that's going to be 30,000 multiplied by 40%, which again has to be 12,000. So in case of cross-section dependency, how do we decide whether we should use additive relationship or whether we should use multiplicative relationship? Now this decision actually is driven by the nature of relationship between the variables. How do we know what is the relationship? That can be driven either through our structural relationships or by observation of empirical data, and that's where we come up with statistical relationship. Let's see an example to understand that. So here I'm looking at my revenue and profit trends across last 5 years, and when I look at this, so what I notice is that the revenue is almost doubled from 325 to 650, and I see a similar impact in gross profit as well. That's also doubled, 105 to 210. In fact, when I look at the gross margin trends, I notice that they've been consistently in and around the 32% mark. So that tells me that there's a strong relationship between revenue and gross profit. That means I can here use a multiplicative relationship because my gross profit consistently moves at the same proportion as sales, more or less. Therefore, I know I could use a multiplicative relationship. Therefore, I can say my gross profit for 2019 will be equal to sales for 2019 multiplied by gross margin for 2019. On the other hand, if I look at the operating margin, it doesn't look like the relationship between operating profit and revenue is very strong. The operating profit was minus 3.2 in 2014 and has gone all the way up to 55.5 in 2018. So here, the relationship between these two parameters doesn't apply to be multiplicative, and neither the relationship between operating profit and gross profit. So if we have to use a relationship, we may have to work with the additive relationship between our gross profit and operating profit, where we'll say our operating profit for 2019 is equal to gross profit for 2019 minus the operating expenses for 2019. Now let's talk about panel dependency. Now panel relationships are a little bit more complicated unless we already know the underlying relationships. Of course, there are statistical techniques such as multivariable regressions that we can use to identify a panel relationship, but there are two issues. One is it's a little bit advanced and therefore outside the scope of this particular lesson, and also in practical life as well, it becomes a little difficult to apply the technique mainly because of lack of data points. So let's try to understand what sort of complications we may have in panel dependency. Just look at this data. So I have sales data for January, February and March, and I have cash collected data for the 3 months. So if I mainly look at the cash collected in March, I've collected 260. Where did this 260 come from? One possibility is I got 50% of March sales and another 50% of February sales. So 50% of March is 140 and 50% of February sales is 120. Put together gives me 260. This is one possibility, but this is not the only possibility. It's also possible that the data we got came from 3 months. 60% of March sales, 30% of February and 10% of January. Now how do we know which of the two to take? So it becomes a little complicated, and unless we know the company's cash collection policy or how things work actually on the ground, this would be very difficult for us to model. So a lot of time when you encounter panel relationship where you do not have sufficient data, we may have to think about option B. So for example, we may sometimes model cash collected as a function of debtors rather than sales. That brings us to the end of today's chapter, but before we end, let's do a quick revision. I would suggest you pause your screen here and read it yourself. So in today's session, what we learned was if you know the relationship between variables and if you're given growth rates or proportions, how to use them. But hey, if you have to do it from scratch, nobody's going to tell you what is going to be the growth rate or what is going to be the proportion. So how would you be able to do it? That's something we're going to learn next time. And by the way, there are also terms like forecast, estimate and projection. Are they all same or is there any difference? We'll also be talking about that. And we'll also be talking about some other important concepts such as when to decide whether I should model level or whether I should model change. We'll understand a little bit more intricate aspects of averages. And I will talk about one of my favorite topics, the law of large numbers. And we'll also be talking about the concept of CAGR, what it is not, and what to do with it and what not to do with it. But before you can move to the next session, there is an assignment. You will have to do it. and there are some quiz questions that you will have to answer. Then you can move on to the next session. So see you in the next lesson.